Well, thank you all for joining us. I know that we have a number of folks that are going to be attending as well and are logging in, but I want to make sure that because we've got a really full agenda today, we have an opportunity to spend enough time with you, being able to take some of your questions and really cover the topics that we've got under now our third in the 5-part series on public-private partnerships for resilience, where we are very focused on flood and risk mitigation. Just a little bit of background for those of you who have not joined us in the past. We have a number of relationships and activities underway that really move us into 2021 in this focus of resilience. And again, our definition of resilience is pre-disaster risk mitigation. So we're honored to partner with the Insurance Information Institute. We have, in collaboration with the Institute and Resilient H2O partners, have launched a flagship resilience innovation hub in Houston, Texas, with a network around the United States. We'll be launching that formally in mid-January and have an opportunity to share with some of you who are interested the work that's underway. What you're going to be hearing about today is around the P3 marketplace, and you'll hear from our colleague and partner, Mike Gardner at AKX. Last but not least, underway also is the formation of a new Resilience Innovation Fund, which we look to get launched by the third quarter in 2021. So there's a lot of activity, including what we are doing through these workshops and national town halls. As many of you are aware, Texas, as an example, but this is true throughout the United States, we have gone in and out of various perils and challenges, not the least of which are a series of back-to-back storms and floods that have affected not just Greater Houston, but a number of areas throughout the state. This idea that going in and out of drought and flood in a state as large as Texas also can be found throughout not just the US Gulf Coast, but obviously the southwest part of the United States, all the way through the Midwest and up to the East Coast. So part of what we've been looking at is how do we respond, but more importantly, how do we actually invest ahead of the curve? We're not the only ones looking at that, obviously. Here in Texas, and again, as you can find throughout the country, Texas has a number of state agencies, Texas Water Development Board, Texas Commission on Environmental Quality, the General Land Office, Texas Department of Emergency Management, all are in charge of deploying significant amounts of federal grants and contracts along with state, county, and city bond programs. So one of the efforts that we felt very strongly was the opportunity to take a look at not just the public sector financing and funding, but where all alternative financing, alternative resources can be found, whether it's a resilience bond, different types of public-private partnerships. That's because it seems to finally have reached a level within both the public and the private sector decision-making that this idea of advanced investment really does generate a powerful cost benefit and a return on the investment. This idea of anywhere from a 4-to-1 all the way to a 7-to-1 type of return is creating this interest in new public-private partnerships. And what we felt was through this series, and especially today, we would hear from experts and individuals around the world and in our own backyard that would shine a light on these new models and these new opportunities for public-private investment. So with that, I'm pleased to present my new good friend, Katie Sabo from AON running and driving their state and local efforts. And Katie will have an opportunity to introduce the great team that's been assembled from AON, literally from around the world. So Katie, with that introduction, let me turn this over to you.
Oh, great. Thank you, Richard. Accelerate H2O, and thank you to everyone at KX for convening this workshop series. It's been a really interesting group of people that you have all gathered together to speak. So as Richard mentioned, my name is Katie Sabo. I am the state and local leader for AON's Public Sector Partnership. It is a group within AON that's exclusively focused on addressing some of the largest challenges facing governments today that range from systemic risks to natural disasters and climate change. The group that you will hear from today are truly the best of the best when it comes to these P3 projects, if it comes from advisory, implementation, and really ensuring successful outcomes for all key stakeholders. At the end of the presentation, our hope is that you have taken a lot of good information away, but that we've really focused on three main things. One is our approach to P3 projects really starts and ends with our ability to partner with governments to provide the best advice, strategy, and innovative funding solutions that support and protect taxpayers and your business community. Second, our focus is on resilient infrastructure as a pre-disaster tool, which we think of as first being resistant against physical damage, two, being easily able to restore quickly and cost effectively, and three, having the necessary resources available to make post-event remediations happen quickly. Finally, we know that better data equals better outcomes, and this is really, really critical in the public sector space. We know that governments are under an incredible mandate to provide objective measures, not only of how to invest and where to invest, and prides ourselves in our ability to prove out in an objective way through our proprietary data and analytical models, not only how to invest, but what projects really should be prioritized. So with that, I would like to introduce today's panel, starting first with Liz Henderson. Liz leads AON's Reinsurance Analytics Growth and Innovative Solutions teams, which provides clients with predictive modeling, actuarial, and product management analysis to accelerate growth and profitability. Second, David Bocott, who runs our Growth, Innovation, and Insight for AON's Global Construction and Infrastructure Group. David's primary role is helping key construction stakeholders like owners and contractors and designers find the most impactful mix of risk controls and risk finance solutions to manage their operational and project risks. David has extensive experience in the public-private partnership market in North America and in Europe. And last but not least is Sam Ketley, who is joining us from New Zealand. So good morning, Sam. Sam is our public sector practice leader in New Zealand. Sam has 22 years of insurance industry experience working as an engineer, risk engineer, property underwriter, insurance broker, and technical risk consultant. Sam gained a lot of his experience working in London, Paris, Dubai, and now New Zealand. Sam is closely involved with ports, large infrastructure, and government entities managing the implementation and provision of loss modeling and insurance placements for both above and below assets. His technical understanding and ability to communicate effectively with both clients and underwriters has meant significant improvements in risk management, risk strategy, and optimization of insurance placements. So with that, Richard, I will turn it back over to you.
Great. I am going to hopefully do this transition a little bit smoother of being able to pull our presentation up, which I always remind folks I am still learning how to get all of these different pieces put together. And as we're doing that and struggling slightly, I will admit, there it is. Not sure why it didn't do that. So bear with me, Katie. This is one of my little problems that we keep on having a glitch with before. So
it's no problem at all.
Okay. I think, David, you're leading off. So if you want to make a few welcoming remarks, and I promise I will figure out why this is not jumping up real quick.
No problem. Actually, I think it's Sam. But one thing that I might want to do is, I know, Sam, you are, it's Friday morning for you, and I know that you're kicking off the presentation. So, one of the things that I really appreciate your time joining us all today here in the States is your experience in having an actual successful outcome in New Zealand. So maybe while we're waiting for the presentation to load, you can talk a little bit about your experience in New Zealand and how you partnered with governments there.
Yeah, thanks, Katie, and hello to everybody. Basically, in New Zealand, we haven't had the significant floods per se. We have flooding issues and have had floods and, in fact, droughts as well. We currently have a drought in Auckland, where I live. But what we have had a significant impact is from earthquakes. And we've spent the last 8-9 years working with local government, central government to come up with a solution to do risk transfer for infrastructure. And that's what I'll touch on as we go through today. So this is all around infrastructure and natural hazard risk, and it's not specifically flood related, but it is to do with how we have come up with a solution for using insurance, traditional insurance. So Richard, if we can jump on to next slide, thank you. So a little bit of my background. I'm not from New Zealand originally. I'm actually from the UK. I'm now a souvenir. My wife is a Kiwi, and decided that we were moving back home just 2012, so a little while ago. And if you want to carry on. So the key points today to consider are the fact that we've got infrastructure assets which are critical to community and economic well-being, but they're generally they're just taken for granted, and infrastructure generally is not insured. So Richard, if you just want to keep going through the bullet points, that's it, perfect. And basically that forms part of the massive infrastructure. It's an insurance gap. It's not generally insured, and when there's a massive loss, generally it's federal, state, local government that steps in and has to rebuild infrastructure, often borrowing lots of money to do it. And so we found what happened here is that we had to evolve what we were doing. What we had at the time of the Christchurch earthquake, which I'll show you in a minute, worked, but that was it. It was the end of that evolution. So we had to move on. And what we found is that we couldn't do it in isolation. We had to partner with both government, local government, and even within the private sector. So if we can jump on to the next slide as well, Richard. So what I'm going to cover off very quickly is global events and what's happening globally, and then very specifically New Zealand, just to provide a little bit of context for the example that I'm going to run through. So if we look at what is the next map, this is a 2019 summary of economic loss events globally, and the size of the circle indicates the size of the loss, and you can see that events are happening everywhere, and some of them are significant. Obviously, there were massive events in the US, North America, but also you've had, certainly in Asia and Europe, you've had significant losses. And these are economic. So some of this is insured, some of it isn't. And if you go to the next slide, what you'll see is predominantly the economic loss and what is insured varies by region. So the top line there is what's happened economically, and the insured loss is significantly less because not everything is insured. And a lot of what's not insured is generally the infrastructure, be that roads, water reticulation, that type of asset. If you go to the next slide, what you can see though is over time is that the trend is the losses are increasing in frequency and magnitude. And part of that is due to the fact that we just keep building in areas probably where we shouldn't, but also the value of assets is increasing year on year. It's interesting to note, though, that as $1 trillion of private capital has been raised globally for new infrastructure, and this has been wanting to be used, but it's wanting to be used in a resilient or sustainable way. The issue is that sometimes we reinstate assets as they were, and we don't focus on the future of what we should be building and how we should be building. So that's something, again, we'll touch on in a second. Jump on. So specifically in New Zealand, the numbers are not insignificant, but you'll notice the top line there is 2010, 2020. The earthquakes around in the South Island in New Zealand were significant 2010, 11, 12, and we still have aftershocks to this day in Christchurch. But the losses were enormous. Those numbers are actually out of date. It was about a $35 to $40 billion loss for the earthquake sequence in Christchurch. And if you ever went to Christchurch in New Zealand, you'll see that the city is still devastated, with the city centre still not rebuilt. And the earthquake sequence, Richard, if you go to the next one, that's it. So just to give you an idea, on the severity point of view, the earthquakes we've suffered, the red dots there show magnitude. These were big earthquakes, magnitude 7+. And Kaikoura, which was 2016, was a reminder to us that the earthquakes in Christchurch weren't just in Christchurch. Although that's quite low in the South Island, it actually hit Wellington, which is 300 kilometers away, and caused billions of dollars worth of damage to the building infrastructure in Wellington. So carry on. Yeah, so we do suffer losses. Here's a stop bank failure from flood. That was a 500-year flood event. Unfortunate, thankfully nobody died. There were people literally in those houses as it went through. So we're suffering a frequency loss issue, and that's being exacerbated by what appears to be climate change. Next one. And Kaikoura, just to give you a size of magnitude of this event, magnitude 7.8, anything above a magnitude 7 earthquake shows at the surface that you can see the horizontal displacement in that road moving about 10 meters horizontally. And the next slide shows you the vertical displacement as well. So, 3 or 4 meters. In places, it was 10 meters high. So when you imagine that that's traveling at 2,000 meters a second when it's going, you can imagine the energy that's being released. So what we found is that traditional insurance and risk transfer is part of any risk management strategy, and is needed. Yep. Generally, infrastructure is not insured. We generally focus in the insurance industry on point asset, vertical structures, buildings, not necessarily networks. It's very hard generally to model what happens to a network, although we're getting much better at it.
Can I ask Sam, just sorry, but explain a little bit about when you describe the network. Is this a communications network or a transportation network? What?
Any network.
Okay.
Generally, yeah, any horizontal network. So roading, rail, telecommunications, water reticulation. So when I'm talking horizontal network, that's what I'm talking about. Transition and distribution lines are generally uninsured. Water reticulation systems are generally uninsured. And you might insure the point asset within the network, but not the actual network itself. But as anyone knows, the network is inherent on all of its entirety to operate well. And if you start losing parts of it, then you have big issues for providing that service to the community.
So this would be inclusive of watershed networks, water sub-basin networks. Got it.
Yep. So, and I'll show you in a second what I mean by water. The reticulation is the key bit that I'm going to be focusing on in the New Zealand example. The value of these networks is huge, but they are distributed. So you've got to be smart in how you apply the insurance. There's a question from there. Yep, it's uninsured. Yes, as in it's uninsured. It's not the transfers. The risk hasn't been transferred, but yes, it sits on the balance sheet of whichever entity owns those assets. And generally, what we found, we've been improving this, but there's a lack of information on that network. Although, to be honest, there is usually a lot of information. It's just not being transferred through to the people who need it. So. Next one. So in New Zealand, we've got 78 local authorities, and they range from Kaikoura is 5,000 people. So there's nobody there. You saw the beautiful green fields. Auckland is 1.5 million people. It's the biggest city. The local authorities are responsible for the three waters, the wastewater, stormwater, water supply, and river management, and local roads. That's approximately $80 billion of assets across New Zealand, so it's very spread. And that risk is shared between local and central government. So if a big event happens, they're both meant to step up to the plate. And in 2010-11, when the Christchurch event happened, there was about $1 billion available of risk transfer, traditional risk transfer for those 4 waters. Christchurch Earthquake, just to give you an idea of what happened there specifically, it's only a magnitude 6.3 earthquake, so not big in terms of the Kaikoura event, but it was very, very shallow, it was very energetic, and it was slam bang in the middle of the city. So what it demonstrated was what could happen to a city if it's hit by a big event. And this is an example of lateral spread. So that's literally the road slumping towards the river. And the next slide, which is the one that really is of interest if you're talking about water, and this can happen in places in the US in particular, this is liquefaction. So this is where the water and sediment below the ground comes out to the surface, and it just destroys every single building. And it's a secondary impact. The shaking damage happens, and then liquefaction can happen for up to hours after the actual event. So what happened in the risk transfer, the $1 billion was exhausted. The central government did respond, in fact, over and above, because the $1 billion wasn't enough. But the interesting thing in New Zealand is we have a huge penetration of insurance in both the private sector and the public sector. And it's probably, it's one of those things that actually they say prevented New Zealand seeing the worst of the GFC was how much money was being pumped into New Zealand at the time. But the issue is when you exhaust an insurance market, it's expensive to reinstate. So we had an issue where it worked, but then the insurers were burnt, and how do we recover insurance market when they're not so keen to give it? Next slide. So we had to think out of the box, and we decided basically that sorry, going, that's it. Yep. So we've had to partner with both local government, central government. Yep. We realized that we ourselves, we had part of the solution, but not all of it. And we needed to involve the clients, the engineers, technical engineers outside of AON, hazard experts, data analysts, broking, valuations. A key part is valuation. People don't value assets for reinstatement for insurance purposes. Generally, they do it for depreciated financial values. And so that was one of the things that we've learned, that we need to ensure or make sure the value of the assets well understood. And so we've partnered through this, and we'll go through what that has done. So keep going. So we spent a lot of time understanding the issues, the assets, the information that was available, what can happen, and the vulnerability of those assets. And Liz will touch onto that more often. But in New Zealand, we were looking specifically at earthquake predominantly because that's our severity event. But we are able to focus on frequency event like flooding as well, up to severe floods. And one of the things we did was we just got much better at understanding the issues and transferring that understanding to the client, not just the engineers within the client base, but also the financial risk people within the client base, and try to break down the silos within the client itself to make sure that the engineers and the finance people were understanding the issues they were facing collectively to deal with the risk. Next one. And you can't really see it there, but that's looking, the brown there is actually a lake, and the blue is the mountains, just to confuse people. But in the middle of that, there is a city. It's a beautiful city of Queenstown, well worth a visit if you come to New Zealand. But it's an area where it's prone to earthquakes, and they wanted to understand what the earthquake exposure was, because if something happens, they're very isolated. Next slide. Then what we've done is we've linked together the loss estimates, so the frequency of loss, severity of loss, and we've transferred that through to the risk transfer program. So if you show that, yep, so that's showing you where you can transfer, what risk you're retaining, and it's an informed decision. So you're understanding what risk remains either at the bottom end or the top end, and you can set your balance sheet and how you're going to fund those areas if you exhaust your risk transfer. Next one as well. And the other key thing was linking the loss modeling is sufficiently detailed because we've used engineering consultants, that we've given the information back about the asset performance back to the asset engineers, so they can start looking at the actual infrastructure network and highlighting where areas need to be improved. Or if we've identified an area that's vulnerable, they've already mitigated, we capture that and put it back into the insurance program, so they get the benefit of the fact that the damage expectancy is less than we thought. So it's a virtuous cycle of transferring that information. Next one through. So we've come up with, you can see there, it's a way of sort of funding the program. It's a mixture of central government, local government, private equity from the insurance markets, and we've linked the loss modeling through to that entire program. And we spend a lot of time with government entities explaining that with engineers on board, and through that we have actually transformed the asset management piece and linked the financial and the physical risk mitigation together so that they're getting maximum value of what they do. And it's also informing land use and reducing where we build where we shouldn't. And the last one is just to show you the cycle that we go through from a risk governance point of view. There should be a hexagon that there we go. So it's understanding the risk, what can be afforded, understanding the loss expectancies, and then working through the physical risk mitigation, optimizing the risk transfer piece. And then as you just keep going around and around and just keep improving the understanding. So what's that meant?
Sam, let me ask one other, and this will tie in to the other parts of the presentations, but I think you just raised a very, very interesting point, and that is the either connection or, more importantly, the disconnect between the financial risk modeling in the hydrological engineering modeling about where to focus on assets. And I know Liz and David will touch on that, but I think this is a great point to keep in our minds as we go through this.
I guess because of my background as an engineer, but also working in insurance for a long time, I kind of helped to understand that bridge and bring that together. But now we have more engineers actively engaged in the insurance placement. We actually take an engineer from New Zealand local government to London to present to the markets. It just brings great credibility to the story that we're telling around how New Zealand is managing their natural hazard risk. And through the approach, I mean, we started 2012, we had no local government entities taking an insurance program. 68 out of the 78 now use our program. We've increased the amount of capital available from $1 billion, even in the hard markets. Hard after Christchurch, hard again after Kaikoura. We've got the earthquake capital for that three waters infrastructure and the river management assets up to $9 billion available for local government. We've done that through actively engaging the insurance markets. They're on the journey. They've bought into the fact that they're helping to maintain those resilient communities in New Zealand. And the key thing there as well is we've introduced risk more actively into the asset management piece and got the leadership of councils at a local level understanding the importance of those, the physical and the financial mitigation being linked together. We found that you spend more money up front end, which is what you've talked about already, but it is cost effective and it does help that decision-making process. Okay, very quickly, So we've started our journey. We're conscious that we've got a long way to go. We've got, there's a whole bunch of flooding issues. Flood now is becoming a predominant issue focus for us, interestingly enough. We kind of understand that earthquake bit, but yeah, we've learned a lot that we can enhance what we're doing at a local level and it filters through to the national level. We haven't been able to do what we've done without partnerships with engineering consultants, internal partnerships. We've had to work hard between, to break down the silos within ourselves and also within the client space. And we've got to link the physical and the financial to get good outcomes. All right, I'll pass on to Liz, I think.
Sam, I was just going to make a point that one of the issues, obviously, is that currently the governments fund a lot of this globally when stuff like this happens, and I think given the structure, you've really done a public-private partnership around risk financing, and I'm curious, is there an improvement in the liquidity, like the speed at which the money is going to get deployed in the event of one of these incidents? Obviously, there's a lot of knowledge now as to what should happen. So that should obviously help in speeding things up. But I think liquidity is a key part of this aspect too.
It's still in a traditional insurance policy, so there still has to be the claims management process. So that is obviously, it does delay it. But we are spending a lot more time on the condition assessment and assessing what the asset state is pre-loss. And a lot of that means that when there is a tangible event, we can demonstrate damage far quicker. And that means you get through the argument around was it damaged by a certain event, we get through that state a lot faster. But there are opportunities to use, if in traditional insurance is not available, to use a parametric type cover and the natural hazard understanding, which would allow you to pick your parameter for your product, which would unlock that finance a lot faster, because it doesn't need to go through a claims process. It's just the parameter. If you breach the parameter, you get the money, even if there's no damage. But yeah, at the moment, we'd argue we're seeing good claims outcomes, but there is the traditional insurance lag from claims management.
And David, I think that's a great segue to Liz, but also points out that those of us who don't completely understand all the elements of insurance is that there is a robust look at how to use data before to assess the actual set of assets, whether they're public or private, but also that there's some changes being made in the policies and products that the insurance industry is coming forward with. And that's one of the reasons why we thought this was important to have AON, at this stage of the learning curve, is the understanding that there are some new, different types of products and opportunities. So, Liz?
Great, thank you. And really tough to follow you there, Sam. What a great example. For my section here, I'm going to step back a little bit and get into the details around how do we even begin to get our hands around understanding how much risk we really have that we're exposed to on our balance sheet. I think there was a question earlier that was so great around, does an uninsured asset, does that really just mean self-insured? And absolutely, if you're not purchasing or transferring the risk into another market, you're holding that risk. And whether you understand or quantify or hold enough reserve to pay for that future risk is something that can vary depending on how robust your risk management practices are. So one of the things that we really emphasize when we start these types of discussions with clients is that starting point of understanding and measuring your risk, and how do we do that? So if you think about risk, you click.
Yep, sorry.
Yep. There are three components that we always think about that come together to give you that measure of risk. The first component is the hazard. If you click again, that really gives you information on understanding what are the largest sources of volatility that you're exposed to. If you want to think through some of the examples that Sam gave, earthquake and flood in New Zealand are the sources of hazard that drive volatility to the people living in that area. Depending on where you are geographically, that's obviously going to vary. The other thing you want to understand is your exposure. So what assets do you really have at risk relative to where the hazard is greatest? And there are challenges around gathering and understanding the amount of exposure at risk. It can be anything from physical property, businesses, homes, government buildings, horizontal infrastructure, which brings a ton of challenge to modeling, as well as additional sources of loss after an event. So cleanup costs, increased expenses due to demand surge after large extreme events, environmental costs, the cost of rebuilding at a better rate or a better standard than you existed before the event occurred. Those are all the exposures that can drive the ultimate loss. And then finally, you really need to understand the vulnerability. The vulnerability is an understanding using engineering experts as well as detailed claims data from the insurance industry. How well is a single asset going to perform when it's exposed to that hazard? You bring that together and you really have a deeper understanding of the risk that you're holding onto your balance sheet. So now if you go to the next slide, when we think about catastrophe risk in Texas, and this framework really is true no matter where you are in the world, there are both acute, which are severe, singular, and destructive events, and chronic, frequent, systemic, and ongoing events that can cause loss in different ways. So in Texas, if you think about one of the unique things about the state is that you have a lot of exposure to both types of catastrophe risk that we typically see modeled. On the acute side, you have severe tornadoes that are relatively infrequent, but can cause a tremendous amount of loss. You have hurricanes that are large, very destructive events, but then you also have this chronic drought, flooding, increased wildfire activity that may not on their own in a single event cause as large a loss, but the fact that they're occurring more frequently and they occur kind of all of the time, are starting to really drive an impact and drive some volatility into your reserves. An interesting thing to note is that when people think about catastrophe risk in the United States, they often think about Florida hurricane as being the driver of insurance capital and reinsurance capital, and really anybody who's thinking about risk management. But on a 15-year average, Texas actually ranks #1 out of all of the states in the US, with Florida and Louisiana kind of a close second and third. And that's really driven by those chronic perils that you don't see in other hurricane exposed states. So if you took out severe storm, hail, straight line wind and tornadoes, Florida and Louisiana would suddenly pop in there as #1 and #2. So it kind of speaks to the challenge that you have to really understand what's that single event that I need to make sure I'm protected against, and then how am I also defending against these chronic things that are happening every year that are going to slowly erode my liquidity over time. So that's really where catastrophe models come in. One thing that's really critical to understand about CAT modeling is that models that are available today really provide a view of the physical risk. They're built and predicated upon damage to properties and locations, and they're primarily based on a current view of the climate. And that's going to be important when you're thinking about investment in new infrastructure. Make sure you understand what model you're looking at, and it's adjusted to reflect what is this risk going to be exposed to in the future as well. Catastrophe occurrences are really rare. Oh, back.
I'm sorry.
Oh, one more. There we are. Even though we often think about, and we hear in the news that catastrophes are happening more frequently and they're causing more loss, and they are, these events are still relatively rare, meaning there isn't enough information from these events as they occur to give us enough view of the entire spectrum of possible event. So CAT models fundamentally fill in the gaps in the historical record to give you a sense of not just what's happened in the past, but what are all of the scientifically probable events that can occur that will affect my exposure. The other things that CAT models can help you address and understand is where populations have grown, where new building codes have been implemented that really change and alter the risk landscape from some of these historical events that we're looking at, and getting a more current view of how the risk will evolve. So now
Liz, are we getting to a point where the data is such that we can actually begin to project with some sense of accuracy what we're looking at based on the historical and current, what we're being able to say 2, 3 years, 4 years out?
Yes, we are absolutely getting a lot closer. And I think it's really a key part of doing this risk assessment is knowing, what am I exposed to today? And then bringing in the additional tools to understand what my risk is in the future. We have recently partnered with the Climate Service, which provides us a way to measure the change in hazard and the change in loss potential due to climate change over time. So that helps us to understand, hurricane loss today, how is that actually going to evolve over the next 10, 20, 30-year time horizon. Most climate solutions or climate change solutions at this time are still looking at a scenario-based model. So that's a little bit different than a catastrophe model, because catastrophe models simulate hundreds of thousands of different events and have a view of the average frequency and severity that you might see. A scenario is really taking a set of specific parameters and modeling that same set of parameters over time. So it doesn't give you that full ability to calculate a probability distribution, but it does tell you a lot of information about what's my relative risk and how is it changing. So if you bring those two things together, you really can get into some powerful metrics around current and future risk.
Richard, I think your point is a good one, because I think with technology and data coming together, we're really getting to a point where you can really focus on, rather than total cost of the construction project, like if we're going to do a resiliency project, how much is it going to cost? And then, the taxpayers are like, oh, that's a lot of money. You can really get to the, okay, if we don't do this,
Right.
here's the total cost over the life of our city, right? And you can get that more and more accurate with some of the stuff coming out. And I think obviously that's really the end game here. If you can start procuring with a total cost of ownership mindset, you're really going to save, your community lots and lots of money. And owners of their own assets doing it in the same way are going to save a lot of money. So I think it's a movement that's being brought to us by just the advancements in technology and data science.
Yeah.
Perfect.
Do you want to get into that? And I touched on some of this already, but I think the other thing that highlights the need for modeling is, we are seeing in the historical record an increase in the losses that these perils are causing. So these two charts show both the total economic loss by peril, as well, and the chart on the bottom is the insured loss by peril. And one thing that's really highlighted when you start looking at those two different views of losses is that there is a gap between what the insurance private capital is picking up and paying for and what is left over to cover, and that's covered largely by governments, federal, recovery dollars, local governments, and individuals, aid organizations as well, kind of coming in and filling that gap. And so part of our efforts in understanding this risk, identifying these gaps, is to come in and bring more capital to narrow that down as much as possible. Insurance absolutely plays a role in resiliency. And the more that we close that gap, the better that we'll be able to recover quickly. What's driving this loss increase are two different key components. So on the next slide, we'll get into that a little bit. So the first big, obvious, item that we all kind of hear about every day now is climate change. So there's clear evidence, especially in the shorter historical record, that we are starting to see some trends in increased frequency, increased severity, and changing weather patterns that drive some of these events. So the science is still evolving between how exactly climate change is going to impact each individual peril. So for example, hurricanes, there's been a lot of research in, is climate change going to change the frequency of hurricanes that we see? Is it going to create more severe storms? Is it going to create wetter storms that cause a lot of the hurricane precipitation flooding like we saw in Hurricane Harvey? And so that's, there's some parts of hurricanes that climate change, there's strong evidence that it does have an impact. And there are certain components of hurricanes where there's less of evidence that it actually will drive a trend. On the other side, obviously climate change fundamentally is going to cause greater average temperatures, extreme temperatures, longer heat waves, longer dry seasons, more droughts, more conditions that cause disruption to productivity and people's livelihoods. So, the evidence is pretty varied across the peril. And as we start to dig into and link the climate change component into the CAT modeling, we'll kind of dig into how each peril needs to be adjusted. Another really key component to what's driving the loss increase is population growth and building houses and where people build. This is just a map that shows the housing units by county change since 1940. And if you even using your intuition, you can look at this map and see the largest increases are happening where there are the most events. So the southeast coast of Florida has significant population growth. And there's a lot of activity there. Harris County and Dallas County in Texas, seeing a lot of exposure growth there where there are tornadoes, wildfires, and hurricanes. California, and we've all been watching the news about California and all of the wildfire activity there, and where people are living and where the population is growing is right where that hazard is existing. But not only are people living in these areas, but the average size of houses and value of homes has increased over time. Houses have gotten bigger and bigger. I guess it's an American thing. We really like to have big houses. And that absolutely drives the loss. So when an event occurs, if your house is a lot bigger, it's more expensive to rebuild. The materials tend to be higher value. If you have a big house, you tend to have nicer materials that have been used to build that house. You have nicer things inside that house, and all of those things combined drive a larger loss.
Liz, can I ask, and again, I want to, recognizing we have a certain amount of time and so many different questions along the way, but I think the other issue that this map raises is not just the housing stock, but frankly, the sector, the industry sectors that exist in these locations, right? So this vulnerability for the oil and gas, petrochemical, plastics, in one part of the Gulf, is that also obviously taken into account? Is the being able to restore, the business continuity, the ongoing enterprise? How does that fit into this?
Yep, no, that's a great question. And from a modeling perspective, typically what they use to estimate downtime after these modeled events is to look at historical data. So how quickly have they, did the lights turn back on? And that's sort of really the extent of their assumption there. Some of the challenges along the Gulf in particular is that a lot of the utilities are really close to the water. And so I don't have a great example in Texas, but I have a great example in Florida. There's an airport in southern Florida that is a smaller airport that was built to serve a large utility provider. And that airport and that utility provider that provides most of the power to like the Miami metropolitan area is now underwater 50% more often than it was previously because of chronic nuisance flooding in that area. So Miami is a very low-lying, part of the country. The bedrock under Miami is limestone. So you get these king tide floods where the water, comes in not just from the sea, but also up from under the ground itself because it's so porous. And this utility needs to be moved and is causing quite a lot of issue there. So, that's absolutely part of the question. So how do we bring all of this information together from a modeling perspective? So one of the benefits that we have within AON is our impact forecasting team. So impact forecasting is our wholly owned catastrophe model. And what that allows us to do is we have access to the engineers and meteorologists and climatologists who build these models directly. So we can kind of bring in all of these different assumptions and different challenges and understand how is that going to impact these modeling results. So if you start from the hazard component of the model, there are two parts of that that are really, really important to understand. First is just the overall event generation. Where do these events occur? How big are they? How frequently do they occur? And if you think about climate change and future risk, how are those signals changing the overall event generation? Then you also need to understand the local intensity because that's what's really going to matter when you're looking at individual assets and how they're going to experience the event when it occurs. So that's really getting detailed around the wind field at a fine resolution, the soil type, how elevated is the risk relative to where the floods are going to come in. And that really refined understanding of the local intensity helps us to build out and into the vulnerability component. So the vulnerability is where, the understanding of the asset is needed. The understanding of the local intensity and the local hazard is really needed. And then that calculates, what's going to happen to that risk when it is exposed to a particular type of intensity. So for example, if you have a house, you want to know where it's located. You want to know what kind of construction it's built out of. How old is it? What kind of, sorry, chat is blocking my screen. don't know how to close it. Okay. Where it's located. And then this is built primarily on claims information from the insurance industry, as well as engineering judgment. So the insurers do a really great job at collecting data on every single claim that they pay out. So every time there's whether it's a large event or a small event, they know exactly how much these events cost them. And that is really valuable, rich data that can be used to predict the future loss on a particular house, exposed to a particular hazard. And then finally, like really where it all comes together is that financial loss calculation. And what's really interesting and exciting about where we're getting to with some of these projects is that we're taking what's primarily a physical based model that's concerned about the actual damage and cost to rebuild a risk, and looking at where does that cost ultimately end up along the entire value chain. So how does this loss get split between homeowners, insurers, and government entities? And depending on who you are and which stakeholder you are in that process, your portion of the loss might change. And so we've built models to really think through how does this loss flow to all of the different stakeholders. So I think next slide. So how can we change the outcome? And this is really where some of the work that Sam's done in New Zealand is getting especially exciting as we expand into other areas as well. There are two ways that we can change the outcome by implementing risk mitigation. And that risk mitigation could come in the form of infrastructure improvements or individual risk improvements. So if you think about infrastructure improvements, those are really necessary to change the hazard that buildings are going to be exposed to. So levees, seawalls, investing in greater wetlands to reduce flooding in an area, those types of improvements will reduce the amount of the depth of flood or the amount of flooding that somebody will experience in a particular area. The challenge with this is that you need a deep understanding of the engineering as well as a deep understanding of the current hazard in order to draw any meaningful conclusion as to what impact the infrastructure will have on the overall hazard and the overall risk. And that's where the partnership becomes incredibly valuable, because we can bring in the modeling and we can look at the kind of current level of hazard that locations are going to be exposed to. But we need that engineering expertise to tell us, this level of seawall is possible to be built, and we can model through the benefit and start to quantify for all of the capital investors or insurance providers, what the benefit of these investments will be. The other thing you can do is change the vulnerability that's in your region that would drive loss after an event. And if you think about it from a public sector perspective, one of the things that's really meaningful and really impactful are implementing new building codes that are driven by kind of engineering expertise. So modeling that vulnerability component of the model really helps you understand what are the key building characteristics that mitigate loss. So if you are in a flood zone, your elevation, the existence of a basement, if your foundation is raised or not raised, or it's flat on the ground, that level of information can really help understand, how likely is my home or building or property going to be damaged, and what do I need to address in order to reduce that likelihood of damage in an event. So, the challenge we have is we have to incentivize everybody who's kind of in this area together to invest in improvements in their homes. And we can do that through, building code requirements, retrofitting grants. There are some parts of the US and California in particular where, the state entity has created grants to encourage people to retrofit against earthquakes. So there's opportunities to improve the building stock and make it more resilient in your communities. So why does this all really matter? One of the things that we think about quite a bit when we're talking to public sector clients is that, really the loss that you have, that you're exposed to, is not just the direct damage that you need to pay out to rebuild your owned assets after an event. That's clearly a component of it. But you also are stewards of the economy and the health of your citizens in your area. So we did a study on Hurricane Katrina and the impact that that had on what's called the State Coincidence Index. So a coincident index is something that's published by the Fed, and they have this data kind of tracked monthly. They release information that looks at employment, unemployment rates, local GDP, sales tax revenues. It's 5 or 6 different components that they bring together, and they create this index. And it's meant to be a measure of the health of the economy at a more local level than, you know, national indices might indicate. So what we've done is we took the past data before Hurricane Katrina happened, and you can see on the chart at the top, the blue line is a modeled curve and the red line is the actual information. And before Hurricane Katrina, those 2 lines match. After Hurricane Katrina, the blue line shows what the coincidence index would have been if Katrina hadn't happened. So the measure of the economy and the health of Louisiana, if Katrina hadn't occurred and they'd been able to recover quickly, it would have followed more closely to that blue line. Of course, the actual event did occur, and as we all know, it took an extremely long time for monies to come into Katrina, to Louisiana, to help them rebuild. They're still rebuilding to this day in parts of New Orleans and the 9th Ward. And that gap between the actual and the modeled is the opportunity cost of not having strong resilience and strong liquidity options to help you rebuild quickly after an event. So this is really powerful sort of tool for us to help think through what are the ramifications if we don't do anything. So that was my part.
Great. Hey, Richard, I'm conscious of time. So, I mean, obviously I'm going to talk a bit about how you bring together, you know, the various players to do the stuff that Sam and Liz, want to do, you know, basically the public-private partnership aspect of it. We can skip through. This is just, we've done a lot of public-private partnerships. We do a lot of construction. We do a lot of design. So you can just move to the next slide. It's pretty simple. Yeah, ultimately, these are all the stakeholders that end up coming together when you're actually trying to solve for an infrastructure problem, whether it's building a new hospital, whether it's building flood resiliency, whatever the case may be. And I think the trick is trying to find the right mix of expertise. And with resiliency, you heard about assessment and modeling. That becomes a huge component than what you might find when you're building a hospital. So, we have to build that into these P3 models. But the goal is to find the right mix of these individuals, and there are more, as Sam alluded to. There's hazard experts, engineering consultants, natural hazard experts, etc., data analysts. They have to be part of this discussion as well. So you got to put together, something where you got your assessment people, your design people, your construction people, your operations people, your maintenance people for the life of the asset or whatever it is you're constructing. And you've also got the financing, right? So I think that's where obviously a key component comes in. And there's been a lot of money raised to solve for these problems. So, and the ultimate goal is trying to figure out the best options to create the lowest total cost of ownership. So like Liz said, had you done this for Katrina, you would see, the asset being resilient, coming back, and all that GDP is value for money that you need to be conscious of. And we're going to be better at measuring that stuff going forward with data, with technology, with modeling, etc. These are just some of the models. We don't have to get into the details. We can just go to the next one, which is the design, build, finance, operate, maintain model. Basically, you got a government, they need to put something in place. In this case, it could be a region-wide flood resiliency strategy. They then will look to contract. So you can click with the concessionaire. That would be a project agreement. So these are the documents you guys have to put together, as public entities. The concessionaire would, try to figure out, do we need funding? Ultimately, they bring equity to the table. There's PPP consultants that help you put these deals together. They work with the government. They work with the equity. They work with anybody that, that wants them to work with them. And then, of course, you also may need debt, private sector debt. So you bring together the sources of debt, and there's a credit agreement. So that's another agreement that you got to be conscious of when you're structuring one of these deals. And then the concessionaire says, okay, I got to do something. I got to build something. So you need a designer, you need a constructor. And that constructor has subcontractors. So, you can see how complicated these deals can get when you do the ultimate PPP. So you got to be conscious of this design build agreement, right? This is the contract the concessionaire enters into with the constructor to design and build whatever it is we're doing. And then you've got the concessionaire who actually, you've got the operator who is actually going to post-construction operate and maintain that asset to make sure it's meeting certain parameters that are outlined in the project agreement. So that's where you need an operations and maintenance agreement, and they have a subcontractor group as well. So you can see these things can get complicated, but there are no shortage of people, and obviously we've got a pretty good knowledge base ourselves that can assist any government in trying to figure out how to skin the cat when it comes to these type of deals. And I think, Sanjeev had a question before. Obviously there's the marketplace that Michael alluded to, but from our perspective, we obviously have seen how these deals get structured. We don't have all these components, but we obviously know all those components, and we understand how these deals get fit together. We've got project agreements, we've got design build agreements, O&M agreements, credit agreements. And the last one actually is the interface agreement. If you click one more time, which is between the construction and the operator, so that it all kind of fits together as a holistic asset. So that's a bit of P3 101. Really at the end of the day, why would you look at P3s? Well, the traditional approach is that previously the governments retain a lot of risk and when they design and build something, and then they take on the ownership and the maintenance and operations of that asset. With the P3, you're actually transferring a significant amount of risk to the private sector. And ultimately that risk transfer is worth a lot of money. I would also say that there's a significant amount of knowledge that goes into the designing, the building, and the operating of the asset. And that creates efficiency, which also brings to the table the concept of value for money, right? So if you go to the next slide, this is just a pretty busy slide that walks you through the idea of what is value for money. Well, in this case, we're looking at a very simple metric for value for money. The retained risk under the traditional model, which is the public delivery estimate you see there, has retained risk of $20 million in this example, right? And you can see the retained risk because they've transferred to the private sector, the designing, the building, the financing, the operating. So if it doesn't get built, the public sector doesn't necessarily take the hit because there's equity and there's debt that's going to suffer. And I think that's obviously an example of the risk transfer. And in this example, you can see with the P3 model, you would get a value for money pickup of $9 million, right? But I think what you need to know is if you're bringing together the best of the public sector and the private sector to design and build and operate the asset, you now have a plan throughout the life of that asset to make sure it's going to be at its highest value at the end of it, at the end of the concession period, which is a 30-year period. That creates a lot of value for money because traditionally some of these assets wouldn't necessarily be operated and maintained effectively, and you'd be left with a full replacement. Whereas some of these concessions that are being handed over, like a hospital, they're actually being handed over almost like new, right? And so I think that's obviously something that the taxpayers don't have to suffer that burden of having to pay for it. So we can go to the next slide because I wanted to make sure we have enough time for, I think when it comes to the resiliency, I mentioned this before, we talked about total cost of ownership, but what we're trying to do is resiliency brings in other assets outside of the asset you're building. There's the resiliency investment you're making, but then there's all of the public and private sector benefits to that whole community. I mean, Liz probably highlighted the biggest piece, which is the ability to actually avoid having this massive loss of GDP over that was a 10-year span, I think, that she had there, and it was massive. How can you, that's a huge value for money proposition that you can get by going down the road of building a resiliency strategy. And from our perspective, we're looking at it as risk, and we see it as the total cost of risk is being reduced. And I think to do that, it's a combination of the cost of risk transfer, the cost of retaining the risk, and the cost of managing the risk through risk controls. So I think technology, engineered solutions, all the best ideas come to this resiliency project in order to make sure you optimize that total cost of ownership and that total cost of risk. So that's what this slide is effectively talking about.
David, one of the things that we're obviously seeing more and more in the States, especially coming from the Army Corps of Engineers, but any number, is this focus on obviously better than a 1-to-1 cost benefit ratio, right? I mean, sad but true from what I understand, 1-to-1 was actually fairly good for a long time. We built something, so my sense is like you said, the total cost of risk is also something that we sometimes get caught in our silo when we think that that's the real total cost of the risk, when in reality, it's a lot larger and could be a lot longer. Is that kind of what you're
yeah, I think if you look at total cost of risk and total cost of ownership, throughout the asset's life, or throughout the communities, in the case of a resiliency project, you're looking at a region, an economic region, and looking at it from a total cost, comparing it to the actual capital cost of that investment.
Yeah.
I would venture to say that it's like 8-to-1, 10-to-1, like you're going way higher than 1-to-1. It's, you just go look at the GDP in New Orleans. I mean, all that money added up. Had they built a solid resiliency plan, back in prior to the 90s, the toughest thing about insurance and risk management is that you can't really see what the investment does because you did it, and you're like, well, I don't know what would have happened if I didn't do it, right? And that's the trick, right? And that's where I think technology and data actually is starting to help us, assess. Like Liz is talking about predicting the future effectively, and that gives you a very clear picture of the cost-benefit analysis when you're going through this. So,
and David, just to highlight that, because that's a really important point, because it also helps prioritize projects, right? It's this combination of how do you take a really limited, investment, right? So you have, these really constrained public sector budgets, and helping identify what projects to invest on based on the return, not only for that direct, property asset, but also that indirect cost to revenue and expenditures and GDP. Is really where I think you, Liz, and Sam are presenting a really innovative way of looking at these P3 projects, because it's not just a snapshot in time. It's really how and where do I invest these really limited dollars to have a really accretive return on investment later, that you all have proven out in Sam's case that works for a lot of different key stakeholders. And I think that is the overarching takeaway from me from what you all are able to do when it comes to helping advise and consult on some of these P3 projects.
Yeah, and I mean, and Katie, to your point, this slide is really kind of the one that kind of brings it together. There's a bunch of unlocks that we can tap into beyond just the GDP side of it. I mean, the insurance sector side of it. Like, there's certain areas in the world that might not have insurance in 5 or 10 years, right? And so, potentially, and I think, ultimately, if we put a resiliency solution in place for a region, those insurers are going to get a massive benefit from it. They're going to be more profitable insurance business, and so there's a trick of how we unlock that benefit.
And David, I think, and again, I know we're going to be bumping up against a time limit here, but I don't want to lose the opportunity for a couple of things that you're raising, and then I think obviously this ties back into this marketplace, especially with this idea, Katie, as you said, how do you look at the criteria for selecting projects? This is a brilliant way, David, of phrasing it, and that is unlocking these opportunities.
Yeah.
Because obviously this number one, this insurance sector unlock, right? This is what the general non-insurance perspective is that if we make these kinds of investments, we're helping, in a sense, buy down risk, but what we're also doing is reducing future losses, right? So I think that this is a great way to define this, and that is, how can these partnerships unlock lots of different variables that in one, in just one sector, you may have a limited, I'm pumped about this one slide, not to take away from.
You actually did the slide for me, so I'm done. Thanks, Richard. But yeah, I mean, it's ultimately there. Just let's stop thinking about the stupid cost of the construction and designing things. Like, that's ridiculous. Let's start thinking about the total cost if we don't do it right. And I mean, it's crazy. Spend the money up front, everybody, because it'll save you a lot of money. And the data is going to prove it. That you're going to be able to now know for sure, not for sure, but with a high degree of certainty, if you didn't do it that way, here's what it would have cost you. And I think that's the problem as humans. We can't process the future when there's two options. We only see the one option unfold, but now we're going to be able to say, no, that would have been what happened. Okay. And I think that confidence level is going to allow us to unlock a different way of procuring and operating assets.
And then the other part, David, I think, again, pointing to number 3 here, all right? Well, we only have a certain amount of bonding capacity. The taxpayers are only willing to go to, to their pocketbooks a certain amount of times, which is appropriate, right? But that means that you are limiting the potential for a full resiliency portfolio of making your community and your infrastructure.
Yep.
So if I,
money, if you're just going to sit there, wait for things to happen, you're in trouble. You got to start getting ahead of this because there's a lot more black swans than there used to be. And I think, time to get ready.
Right.
So anyways, I think, at the end of this is just a concluding slide. I think it was part of Sam's section. So I think it's obviously it says there are smarter ways on how we respond. And, clearly we're trying to articulate that. And, ultimately, we're here to help however we can and trying to build out that data so Liz can tell you with greater certainty, if you did it this way, here's where you're going to be. If you did it this way, here's where you're going to be.
Well, so I think what I'd like to do, and I know we're going to run out of time, all right, but I want to make sure Michael get a chance to show a little bit about the marketplace, because Katie, this does begin to address this idea of the different sets of criteria that sometimes government has their certain level of criteria that go into it. The insurance or investor community has a number of other criteria. I think what we're really trying to say is this is a blended scenario of taking not just the all-in cost, but frankly, the impact on who at the end of the day is bearing the risk and the loss. Am I saying that correctly?
Absolutely. There's just a comment in the chat from C. Edwards, and this is exactly that we are observing this in all of our modeled views, that the best time to invest in these projects is right now.
Yeah.
Right? And that is where you're going to get not only an actual creative solution, but you're going to protect your tax base. You're going to be competitive in a very on a global scale from a business community standpoint. And so we couldn't agree more that what we're trying to do is help invest now in some of these projects so that the return later really benefits not only taxpayers, ratepayers, but your business community.
So we know that we're past a little bit, but I'd like to beg folks, if you don't mind, to stay with us. Michael, are you able to, I think I've shared the screen with you. Are you able to?
Yeah, hopefully people should be starting to see my screen. And so let me just say that thank you to the audience and attendees for hanging in there. I'm only going to take about 3 minutes to just give you a peek of the marketplace and talk about a couple points, but I'll be very brief. But thank you for staying with us. And then to the AON team, wow, thank you for those fantastic presentations. They were, Richard and I spent a lot of time talking about resilience finance and P3s, but those were fantastic in terms of helping clarify and demystify and also get into very critically important details. So thank you for that. And to follow on to a number of the concepts, the presentations were talking about the need to eliminate siloed thinking, about the need to facilitate collaboration as working through all these different issues, quantifying risk and so forth, and the importance of using models. And Richard and I we've been talking about this for a couple of years, and we came up with this idea for the resilience marketplace. And we're looking at it right now, and to show you what we're seeing, and then I'll kind of show you an example. Well, I'm going to show you one example of how it can be used, and then I'm going to show you kind of the big picture about how it's designed to work. But what we're looking at here is a little bit like, say, eBay, where you're looking at projects, and the way that this is being presented, so this is one use of it, is that a funder, which could be a commercial investor. It could be somebody in a government agency that actually has funding to disperse. It could be a nonprofit that's looking to make a grant. They can come in and they can essentially shop for projects basically and say, well, like, hey, I'm looking for a project. I want to find a good, I want to find a good flood mitigation project, basically, show me what you have. And they can, within the marketplace, they can then open up the project and they can see all the information on it, including, a summary of the project. We can integrate. One of the things that's very powerful about the marketplace is we can integrate data. I won't have time to show you that, but I think that fits right into what AON was talking about the importance of data and information and the importance of models that bring that together, basically. We can show the organization that's behind a project and so forth. You're probably wondering what the heck are these icons, basically, and what these they are model-driven scores that can show things. By default, we show the confidence in the construction and the confidence in the financial model of the project and the environmental benefits and the social benefits. But we can, and we will, during the lifetime of the marketplace, we will have many, many other icons that are, again, model-driven. And so for some of the things that the AON team was talking about, right here, when the investor or the funder is considering the projects, they can see like, oh, this is a really high, this project is going to do a really good job of reducing exposure on this one particular type of risk, for example. And so over time, we will be bringing more icons on, and we'll be and hooking those up to models and so forth. I just wanted to show you one example of the data room, because when so in Houston, there are hundreds of agencies that need to be able to collaborate and figure out how are we going to work together. And I'll show you kind of a view of that in just a minute, basically. But one of the things that they can do using this software is they can all come together and they all have access to all the same information. They have a central place where they can share documents and they can collaborate on the project. There's a lot of other things they can do, but let me just show you kind of the big picture around this. And let's just take Houston as an example, but we're really focused on all of Texas. But Houston can bring, and this is really what we will be doing with the marketplace, basically. But all these agencies and nonprofits, all the community, if you will, hundreds of different organizations can all work together. They can run marketing campaigns, if you want to think of it that way, to acquire projects, and the marketplace has places where people can come in and just enter proposals for projects, and so you can run a funnel to collect hundreds and hundreds of projects. The agencies can use those to be able to screen them, rank them, and match them. And again, we have many tools to be able to do that. And in the end, then at the end of that, I showed you the example of a funder that was browsing, but we also have the capability to actually route a given project once it's been screened. And so once we know, hey, this is one of the top 5 projects for this particular goal, it can then be routed to the right funding source, basically. And that could, there's many of those. In particular, in Houston right now, they've actually secured billions in federal finance, but they're now faced with figuring out, well, where are the projects and what are we going to look at? And then how do we collaborate on them? And then finally, which project should go to which of those different funding sources that we've secured? I just want to show you one other thing very quickly, which is the flip side of risk is benefit, if you will. And this is something that another client of ours, of Akayax, basically with a different finance marketplace, these are for stormwater projects, but they had come up with a multi-benefit model, which is kind of I think of it as a parametric multi-benefit model for quantifying the benefits of a stormwater project. And that's what's being used in some of these scores here, for example, or that kind of model is what's being used in terms of those scores. That's just a very quick overview of what's going on at the marketplace. And I'll just leave it at that because I know that we're already having to get on with other things. But
Michael, I think one of the things that a couple of quick takeaways is, and I know that we probably jammed a lot of information into a short amount of time, Katie, but between Sam, Liz, and David, I think it sets the tone for some of the next steps of what we want to achieve, not just with the marketplace, but I think it clearly indicates, Michael, how these criteria and these selections, begin to put some rankings behind it, because ultimately my number one takeaway, Katie, today is something that has been bothering me for quite some time, and I'll just put it out there, and then we'll find some next steps to do the following. Is one, Sam, how do we organize multiple jurisdictions that operate in silos who ultimately are impacted, whether it's an earthquake that starts in one jurisdiction and starts moving down its impact, or it's a flood or a drought, whatever it is. We now know that you've got to cross multiple jurisdictions and bring multiple players into it. And while each of them have their own required standards and rules, the fact of the matter is the economics are crossing these political jurisdictions that are artificial. That's number one. Number two, Liz, I am now convinced that the financial risk modeling has been absent from a lot of the hydrological modeling. It's not to take away from our friends on the engineering side of the world, but the fact of the matter is most places just want to get either more water, get rid of the water, whatever the requirement is. But at the same time, where we actually put what I call the interventions, which is to David's point as well. I can lay out all the interventions I want, but frankly, they may not be the right scale, the right location, or even the right kind of intervention. And frankly, it's those who have the greatest economic loss and the greatest upside for the right decisions, which tends to be the insurance world and the investor world, have a greater voice in this. And so this opportunity cost is something that we all talk about, but it tends to be somewhat outside the political discussion, or to some degree even outside the engineering discussion, which then ultimately gets to what is the right kind of public-private partnership model. And there tends to be at least a baseline of some of the things that need to be in place for all of these. But Katie, the number one for me is having the champions. We can present all of this information, all the modeling, all the solutions. But if we don't have the champions willing to step away from the traditional and really be open to looking at what should not be considered innovative anymore, it's just factual that we now have enough data. The insurance and the non-insurance community is willing to put resources on the table. I'm looking forward to how this conversation and how the marketplace can really drive forward supporting some of these champions. So with that, Katie, Liz, Sam, David, and Michael, thank you all so much. Thank you for the attendees who stuck through. I've gotten lots of text separately that are a whole set of folks that want the recording. So we will obviously be sharing the recording fairly soon, later today. But thank you, Katie. Thank you, Team AON, and thank you, Michael, for your continued partnership.
Thanks, Team AON.
Thank you
Very much. Thanks for having us.
Really great.
Bye.